We get calls from people who just have no idea what's going on in their retirement plan, and they know they have to do something, they know they need a change, but they don't know what to do or where to go, and that's why they're calling us.
I think the main draw is the concern to run out of money, and I think they're looking for some type of answer. You're not taking double-digit losses, you don't need double-digit gains. Is an extra 5% really worth risking your whole retirement on? When you remove the emotions, it's an objective situation. It's not opinionated. Here's the money that you have. Here's what's at risk. Here's your liabilities. Here's the gap. What do we do?
Hey, everybody. How are y'all doing?
Doing great. How are you?
Awesome.
Doing good.
Great, Brian.
Awesome. Well, we have a lot of movement in the news these days, a lot of things to catch up and talk on. Ron, always with your ear to the ground of the markets. What do you hear out there? What's trending? What are we talking about? What's going on in the market?
Yeah, it's very interesting. Well, of course, the story for the last year and a half has been Mag 7 this, Mag 7 that, right? NVIDIA, Meta, Microsoft, the 7. And what's very interesting is that momentum is slowing, and we're seeing a broadening out of the market. So people are actually starting to recognize two things, I think. One is that these things are pretty pricey, these Mag 7 stocks. So we're getting a rotation out of those and into the rest of the market, broadening it out. And that's really a healthy thing.
Sure.
What we don't want to see is everybody just selling those things and running away. That's a signal that, hey, things are going to go south. Mm-hmm. But if they're selling those things and they're moving that money into other assets, maybe small cap stocks, maybe some utilities, maybe something else along those lines, consumer staples, consumer discretionary, things like that. We're seeing that kind of a broadening out, and the broader market starting to come up to catch up to the Mag 7 stocks. That's a really healthy and encouraging sign that things are moving forward. So what we're doing as a result is we're really fully invested once again, and we're watching for places where we can go and take advantage of this new movement.
What about the stuff that we can't control?
Yeah, the scary stuff.
Like the whole stuff that's going on in the world today with, obviously, Iran and Israel and all the wild, crazy stuff that's happening over there. Have we seen that affect things, or are we planning on seeing that to affect things?
Yeah, is that part of the sentiment?
Yeah. So geopolitical risk is always a tough one because the markets a lot of times tend to shrug that off until it's too late. Mm-hmm. We did see a lot of knee-jerk reactions when we dropped the bombs in Iran. There was a lot of reaction, particularly in the energy space and in precious metals. And the other thing we saw was a big drop in the dollar. And all these are interrelated, but they don't necessarily mean that they're going to push the market one way or the other. So it gives us some opportunities. For instance, we were ahead of that. We were already in aerospace and defense stocks, and we really benefited from the run-up in those things as a result of what's going on. And also as a result of the new buying or the new defense initiatives for NATO. Yes. Everybody's saying, okay, we're going to push it up to 5% of our budget, and that's going to have a major effect on those companies. So we're seeing the effects through those channels, and as long as it appears that Iran is contained, in other words,
that's where I was going to go next.
Seen all of their proxies, right? Mm-hmm. Hezbollah and those guys, and their friends,
sleeper cells, and all the weird stuff they're talking about,
right. So the allies, nobody ran to their aid. Hezbollah and the Houthis, they really didn't come out swinging, which is what people were afraid of. There was threats of the Straits of Hormuz being closed off, but didn't materialize. Mm-hmm. And so as those things kind of faded out, then that risk level came down, and that's why we're seeing how the markets have come back to all-time highs.
I think a lot of that has to do, too, with love it, like him, whatever, but he definitely Trump has a definite firm hand on this situation, and he's not letting go. In fact, the word is now, if they push, he'll erase them, right? He'll just destroy them, like it's no question. So if we go into that situation, do you think that's priced in already in the markets, Or do you feel like that would have a detrimental effect? I almost start to feel like it's kind of priced in. People are kind of starting to expect that we might have some turbulence and drama and have to drop a few bombs here and there. As casual as it sounds, I don't mean to downplay it, but it's a fact. It almost starts to become a casual conversation because it's happening consistently and at a point where you would think the market is already starting to expect it.
Yeah. We've talked often about adaptation, how we adapt to the circumstances, right? And I think that we've hit that point where we have adapted to uncertainty and volatility, and so we're accepting it, and so when we see things like this happening, it doesn't impact us as much as it would have a year ago.
That's great news for the consumers
used to.
And the listeners. That's great news, Ron, because people freak out. What if we drop a huge bomb on Iran? Mm-hmm. Are the markets going to go crazy?
Right.
So,
and this is nice to hear that we're adapting and starting to kind of get used to a little uncertainty. And again, because of the president's saying this is how it's going to be, you kind of have that line, you can kind of expect where things may go.
Well, that's interesting you say that people are adapting to the uncertainty. An alternate viewpoint of the same topic could be that maybe there is more certainty now that Trump has put the strong hand on Iran, and now if people do believe that the nuclear, at least, threat of Iran is down, then maybe that is more certainty for the market. So just trying to understand where those risks are ultimately.
How do you feel about that, Ren? I'd like to hear, from your opinion, outside looking in and thinking about, are people concerned and worried, do you think, about that?
I think that there is a lot more comfort in knowing that something's been done, that we're not just sitting there waiting for someone else to do something, that our government took an action, whether you agree with it or not, and that now there's not going to be a worry as much about a nuclear threat, so you can put more effort into other things. And I don't know when we started investing stronger in the stuff you were talking about earlier, Ron.
The defense
stuff.
Defense stuff, the aerospace that he has.
But knowing that now, we've got a little bit more control over what's happening out there, it's going to allow people to start putting more trust into other places. And
that's kind of how I feel about it. Again, going back to that world of uncertainty is starting to feel more certain.
I think
which is a good thing. It kind of aligns with what you were saying, Ron, about how the other parts of the market are starting to kind of close the gap. It's not as crazy as it once was.
And I also think that there are some activities in the world that cause people to worry and pull their investments away. Mm-hmm. And there's other activities that tend to make people worry and just invest smarter. Yeah. And I feel like we're seeing people that want to just invest smarter. Mm-hmm. They're not just putting it all into the Mag 7.
That's a good point. So then the next part of this is, where are we in the cycle of the economy? Yeah. We've been waiting to hit the bottom for a while. Did we kind of hopscotch over it a little bit? Like what, or are we, it sounds like that's what we're talking about. It sounds like we're talking about, we dipped our toe in the water of the recession and we're like, maybe not. And now we're starting to grow. I guess, where do we come back? I know I haven't checked in a while, the GDP, what was the...
We just closed a quarter.
What's the impact of that? What was the closing of the quarter?
Well, we just closed the quarter a couple of days ago, so we don't really have those.
Yeah, we don't have it right
yet. But we do know that things have slowed, and I've been doing research and trying to pinpoint. I wish I could give you a really cool little factoid on this about, hey, this is how much GDP impact every 1% of tariff would be.
Right, that'd be perfect.
What I was looking for, but you can't. You can't find. I'll make something up about that next time. But for now, the best we can do is we can say that the job picture has stayed resilient. Employment is still good. Consumers did pull back, so our consumption has come back somewhat. Net exports, in other words, all the trade activity really got slowed down because of the tariffs and uncertainty there. But the throughput of all that, it looks like the midstream, the wholesalers have absorbed the tariffs so far and not passed on those price increases so much to consumers. And that's really what's helped hold the line on this. So because of that, we haven't had a huge inflation scare, and we haven't had a real drop in growth.
So natural orders of business are up, is what you're saying. Business orders are up. Yeah. They're not down. They're not. You're not seeing.
They're flattish. They're good. They're solid. They're not all of a sudden falling off a cliff.
Which is important.
Manufacturing in the United States. Yeah.
So then maybe we really did just touch a recession and jumped out.
I think we had some factors that led you to believe we're heading in that direction, but ultimately things changed, right? We're talking about all the good news and all the things, all the factors. We got the big, beautiful tax bill. We've got, hopefully calming geopolitical things. We have interest rate cuts on the horizon. We have a new Fed president who's going to get nominated under the pretenses that they should likely be cutting rates into this. So it's really gearing up and setting up that the market should be in a good place. But Ron, with about 30 seconds that we have left, where are the risks right now? This all sounds too good, and usually that's when things are too good to be true.
You're not too much of a cynic there, Brian. It's okay.
I'm normally an optimist, but yeah, everybody's in the bull market camp, and I'm just wondering, as you've always taught me, risk is what's left over after you've calculated everything else, and
right, yeah, there's always an unknown out there, and so they're still out there. The geopolitical risk is still out there. There's still a war in the Ukraine between Ukraine and Russia. There's still conflict in the Middle East, and there's still a lot of discontent here in the United States. We're still very politically divided. The tax bill has not passed yet, and interest rates are still really higher than they need to be. So there's a lot of things that are waiting. We can project a lot of ideas and say, hey, this feels like it's getting better here, and hopefully that's the direction it goes. But we have to be prepared for what might else be, and that's exactly why we always work towards diversification.
Yeah,
because you don't know how it's going to pan out exactly. So we want to be optimally diversified. Pick a direction that we feel is the highest probability where we're going to go, and weight our allocations towards that. And so that's what we're doing with everything right now.
Well, there you have it on the Greenlight Retirement Show. We'll be right back. Hey, welcome back, everybody, to the Greenlight Retirement Show. We're going to keep it moving, current events and things like that. Section 2, if you will, explained a little bit further. A lot of what we have going on here is some good news in the investment world. We have some legislative things that are happening around us right now, all of which is really impacting the middle class, right? Where in middle America, where taxes seem at the highest levels, or have felt that way, right? The Tax Cut and Jobs Act in general felt like it was a tax increase on the middle class, and now here we are with round 2 of a potential cut. We got this big, beautiful bill. We've got AI to be talking about. We've got a lot of different directions we can go in this segment. Corinne, did you want to get us rolling?
Tell me about the big, beautiful bill, because you guys off camera have mentioned that a few times, and me as somebody that.
It's the
average American. Tell me about it.
It's an axiom that the Trump the Trump cabinet, if you will, kind of put together for their tax bill. It's got a lot of good news in there. It's got things like increases to the state and local tax, deductions going from $10,000 to $40,000. There's some benefits to capital expenditures as well too. Ron, did you want to comment on a few things that you pulled out of there?
Yeah, those are big things. They call it the one big beautiful bill, the OBBB, which just sounds like you're stuttering. And it's actually been a long process getting here, and now as we're coming to the end, the goal was to get it all passed by July 4th, and coming down to the wire, it looks like that is really actually a possibility. So we'll see how that plays out. There was a lot of compromises that had to go through because the House had their version and they did a lot of tweaking and compromise, and they got it through. and then they handed it off to the Senate. The Senate went through their same thing, and there was a lot of concern. Is the Senate version going to be so different from the House version that the House won't agree to it, ratify it? But it looks like they're fairly well in agreement. You know, some of the things that were a bit of a surprise were one that Brian hit on was the state and local tax deduction, the SALT deduction, and that was bumped up to $40,000. Yep. But there was a cap put on it, so it's $40,000 for I believe 10 years, and then it has to readjust because that's a big deduction. So as in government terms, they would call that a big expense.
Mm-hmm. And what was it now, just for everybody listening?
Tax credit expense.
10,000.
It's 10,000 now, right?
Yep.
So it's 4 times larger.
It's 10,000
okay.
now.
Well,
so pre the Tax and Jobs Act, there wasn't a cap on it. Then the Tax and Jobs Act put a $10,000 cap on it. Now it's moving up to $40,000. It's going to be very helpful in states with particularly high tax on like sales tax and most importantly real estate.
Mm-hmm.
So luxury goods too,
states
right?
where
sales tax,
luxury, all these things, cars, anything, and all adds up. So you get a deduction for those taxes that you pay up to $40,000 now, and I think that will be helpful. There's a lot of complaint about that because the complaint is that that's only for those rich people. You know, most people come underneath the 10,000, and that's probably true. But most people don't pay as much tax as the people who are paying the higher amounts. So it just balances out in the end.
I'll push back a little bit on that because there's a lot of folks, regular folks, who go get a loan to buy a new car. Average new car payment is near, I think last time I checked, was over $800, which kind of imputes that the average new car price is $60,000 or $70,000, you know, if not a little bit higher than that. I know that we have clients that have over $1,000 a month payment. What people don't really realize all the time is you're rolling the sales tax that you're paying up into the loan that you're receiving.
Into the loan,
and so I remember in 2019 when I bought my wife's car a couple years into this, you know, state and local, the salted cap at 10,000, and almost exclusively to just the purchase of the vehicle, I capped that thing out. It was probably $50,000 car at, like in Virginia, I think it's a 7 or 8% sales tax. So I mean, it was a massive piece. And so people buying $100,000 cars out there, you're going to be thankful that, you know, your cap is higher than 10,000. And then when you start adding in these other things, business owners that are itemizing the taxes that they're paying on their goods, right? That, you know, the libertarian in me wants to come out and say that we shouldn't have double taxation. But if I pay $1 to taxes, I didn't receive that dollar as income. But if I have a cap, even a $40,000 cap, now I'm paying double tax on some of my money if I'm exceeding those thresholds. So yes, it impacts the wealthy more, but I would argue in our segment here that we're talking about the erosion of the middle class and the pressures that are on the middle class, that this still is a ceiling, granted on upper middle America in some ways, but it's still a ceiling for middle America, and it still plays into the overall standard deduction. Standard deduction is about $15K a person, so that's $30,000 for a household. So, you know, there's some people who won't even benefit from that as well too.
Good. Well, you said a lot right there. Can you go back and explain what you meant by double tax? Because I want the listener to understand, because you just rattled off a bunch of nerdy stuff, and we need to kind of break that
Let's
down
slow it down a little bit.
Just a little bit.
So everybody makes...
Take off your nerd glasses.
Take off the nerd glasses.
Take off the nerd glasses.
There you go. I'll do my best.
I'm the only one wearing nerd glasses.
Yeah.
Okay.
I'll do my best here. I'll do my best here. So we make money and we pay income taxes, right? Many people, 22% federal and whatever percent states. You're making money and you're paying taxes, right? But we also pay taxes, and not everybody knows this, but when you go to Target and you buy clothing, most states, I mean, I grew up in Minnesota where you don't tax clothing, but, you know, many states tax clothing, many states tax food, many states tax luxury goods, many states tax a lot of things that you can buy. They tax, you know, movie theater tickets, they tax, you know, your concert tickets, all this stuff. Technically speaking, if you were a really, really good taxpayer, you could keep track of all of the dollars that you paid in taxes, and you could add them up in a deduction. And you could say, hey, well, since I paid these dollars to taxes, it was never my money. It was the government's money in the first place. And the state and local tax exemption cap of $10,000 or $40,000 just puts simply a ceiling on that. So if between the sales tax that I pay, the property taxes that I pay, the consumption taxes that I'm paying, whether I'm dining out or buying goods, if all of that adds up to more than $40,000, let's just say my accountant says that it was $70,000 that I paid in all of the taxes. Well, that's $30,000 that I don't get to deduct, right? 40 cap for
right, yeah,
30
it's $30,000
excess.
more to your AGI.
So those $30,000 are now taxed at ordinary income rates.
Right, yeah, to your
So now I've been taxed twice. I paid taxes on my consumption, my state and local tax exemption, right? That's a consumptive-based tax cap. But I'm also paying more on my income, right? Because I can't deduct that from my income. And so it is absolutely constitutionally not okay, in my opinion, but it is a legal double tax right now. And our Constitution says there's no taxation without representation. We're not going to double tax the dollar, and here we are.
But when you raise it, it has less and less of an impact.
I am not running for government, by the way, but that's just that's just math. I mean, it's not super complicated, but it's just the fact that you don't get to keep all your dollars. Some of them go to pay taxes. Previously, 2017 and earlier, you could deduct all of that if you were a good student and kept track to all of your pennies.
Right.
Nowadays, you just can't do that. Right. So it's impactful, and it's one of those ways, because middle America isn't uber wealthy. They're modestly or moderately wealthy. Those taxes nickel and dime middle America. That prevents us from saving more. It prevents us from investing more. And it ultimately hurts our family net worth as we move on in life. Those are dollars that we don't get to keep.
And also for, people that are getting close to retiring and then retiring, you don't spend less in retirement. You usually end up spending more than you expected, especially when you're like that window of getting ready to retire. That's when you start getting things in order and spending more. And I forgot where I was going with that.
No, but you're right. So in retirement, the point you're coattailing on is it matters more about what you get to keep, right? It's not about necessarily how you manage or invest your money or how much you even have. It's after taxes, how much do you get to keep? How much can you spend? Tim and I talk about this all the time with people. We can't help you buy a boat with your IRA. We're not really capable of helping you buy a business with your IRA. Yes, I know for the nerds out there, there's a way, but this is an informational only podcast. We're not going to go down that road. That being said, we have to find a way to pay our taxes, and nobody wants to pay more than their fair share. It's actually unconstitutional to pay more than your fair share, right? So use the law to the best of your ability. It is a relief. So this is a good thing. I'm not being too cynical. I don't want that to carry over from segment one. It's good news, but at the same time, it is still representing a double tax for some people in our society right now.
Well, and there is a little more good news in this bill, because at present, now it hasn't been signed yet, but at present, as of the time of this podcast,
the recording of this podcast,
there's also a provision for the deduction of auto loan interest. So that is another interesting but very good bit of news, particularly for the middle class. Because most people do finance their cars, and most people, they have to. You can't do anything about that interest. It's just you pay it. Now with this bill, you will be able to deduct that just like you do your mortgage interest deduction. So that can help, and that'll also be a boost to the auto industry and help to get that jump started a little more.
That's in that 40,000.
No,
this is separate.
This is the interest on your note. Just like the interest on your mortgage is deductible up to $750.
The interest on your car payment will be deductible.
Yeah.
Okay.
And so those are all good things. I would also assert that benefits the upper middle class in general, because we still have to overcome a $30,000 household, standard deduction as well too before these things start to matter. And so. Right. Those are some of the factors that the middle class really has to consider. Is what we do well here at Fitzwilliams Financial, Fitzwilliams Wealth Management. We think about those things that get in the way of you and your money, right? We want to focus on helping you keep most of the money or more of the money that you're making. We'll see you next time.